So easy, so easy. So easy, so easy. So easy, so easy.
Good day, everyone, and welcome to this webinar with EasyEquities and Sygnia. Thanks so much for taking time out of your day to join us today. My name is Sean Keeling, and I'll be your host. Before I start, I just want to say Happy Women's Day for yesterday to all our ladies joining this call today. I hope you had a wonderful day and chilled a lot. Today we're joined by Iva Madjarova, the Head of Investment Consulting at Sygnia Asset Management. And Iva will be chatting to us today about Sygnia's latest ETF, the Sygnia Itrix Solactive Healthcare 150 ETF, which listed last Friday on the 6th of August. Obviously, it's the first healthcare ETF to list on the JSE, so it's really exciting to hear more about it, especially, of course, in these times that we're in. If you are looking for a recording of this webinar, it will be recorded and hosted on EasyETFs. So please head over there to look for it later. And if you do have any questions, please feel free to ask, and please put them in the question and answers box at the bottom of the screen. And please don't use the chat box. So enough of intro, and over to my guest, Iva, who will be doing the presentation. Thanks for joining us again today, Iva.
Thank you very much for the introduction. I will get straight into it. Okay. So thank you very much for having me. Very excited to tell you all about our new product and to discuss healthcare in general. I will cover some general educational content before we delve into the healthcare sector as an investment and unpack the product. So just as an introduction, what is an ETF and how did these come about? Well, an ETF is an exchange-traded fund. That's what it stands for. And it's essentially the easiest way to understand it is to think about it like a unit trust, but it's a unit trust that trades on an exchange. It is governed by the same CISCA regulations. The product is essentially a basket of securities, and these securities could be bonds, they could be equities, and these days you get so many types of ETFs. An ETF can also track the price of an underlying asset, such as gold or platinum. How will you know if an ETF performs well? It depends on the underlying asset. So ETFs are very transparent. There's a lot of information that you will have once you invest into an ETF, so you can track the performance as frequently as you want it. But essentially, it's all dependent on the underlying asset. For example, if you have a gold ETF and gold goes down, then unfortunately your ETF will go down. But if the gold price goes up, then the performance of your ETF will be positive as well. A nice little graphical representation of what an ETF is. So as I explained, you can think about it as a unit trust that trades on an exchange. But if you look at this little graphic over here, it's essentially you're buying one instrument. This instrument is a collection of assets. So it could be a number of different stocks in a certain index or a certain sector like we're speaking about today. And this whole collection of assets replicates the movement of a certain index. And the one main difference between ETFs and unit trusts are that ETFs can be bought and sold just like any share. So you can buy them throughout the day, whereas unit trusts are priced just once a day and they trade just once a day. Now, as I mentioned a little bit earlier on, as this industry has developed, and ETFs have been around for many, many years now, especially if you look globally, but even in South Africa, there's so many different types of ETFs. So most track an index. This could be an equity index, a bond index, a local index, an offshore index. But as I mentioned, you also have commodity ETFs that track the price of an underlying commodity. Outside of South Africa, you have actively managed ETFs. This is something that we may see in our local market very soon as well. Industry ETFs is what we are speaking about today. We are speaking about healthcare. Healthcare is an industry, and you can have ETFs like we do now. As Sean mentioned, this is the first healthcare-focused ETF to list on the JSE, and it is focused on a certain industry. And you get many, many different types of ETFs as the industry develops. Some history on ETFs. They came about back in 1990, so they're by no means new to the global investor or the local investor. They have been around in South Africa since the year 2000. So we have decades of history with working in ETFs, and passive investing really became popular already back in the 70s. And due to passive investing becoming popular and attractive to certain investors, that's why the industry, designed an ETF to make it simpler for retail investors, individuals, to be able to buy into a passive type of instrument. And you can see from this little timeline that doesn't go all the way up to the year 2021, but as soon as the first ETF was born back in Canada, not long after that, it was a Standard & Poor's with their depository receipts that were really seen as the birth of the ETF industry back in 1993. Towards the end of the 90s, they became featuring in Asian markets and already in the early 2000s in Europe and in South Africa. So a very, very long history of ETFs, very exciting instruments, and they have many, many benefits. So it should be no surprise to see the growth in the AUM of ETFs in general just continue to grow year on year. So this chart does not date back to 1990, but the early 2000s when they really became popular. And you can see that year on year, we're seeing new product launches all around the globe. We're seeing more and more money flow into ETFs. And we expect to see this continue to grow as investors get more and more comfortable with these instruments. Then we will see the growth in AUM just continue to tick upwards globally. So why is the growth in AUM so huge? Why are these instruments so popular? Why do new ones come to market all the time? Well, there's many benefits to using ETFs, but the main ones are cost. Because these are passive and you don't require big teams of people to go and do fundamental analysis on certain stocks, you're simply tracking an index, they can be very low cost. And we know that low costs are really beneficial to investors, especially over the long term. Access is pretty easy. You can access it via platforms such as EasyEquities, or if you have your own stockbroking account, you can just type in the share code and search for an ETF just like you would search for any other share like an Naspers on your stockbroking account. So very, very easy, and there's options for members and clients to be able to trade these either through a platform or through their stockbroking account. A huge benefit for ETFs that track global indices, and the ETF that we will unpack today is one such ETF. So as an investor in South Africa, you can invest into an ETF that is tracking an index that is outside of South Africa, thereby diversifying your exposure by having exposure to global companies. But when you're buying into an ETF, you're not externalizing your money, and you do not need to worry about the exchange control regulations. So it's a huge benefit for investors to be able to gain that outside of South Africa exposure without having to worry about breaching the exchange control limits. So there are other benefits. There's transparency. Of course, ETFs, you're buying one instrument, but that instrument typically is made up of a number of underlying holdings. So ETFs in themselves are diversified more often than not. So there's many, many benefits, but some of the main ones are cost, the easy access through various platforms such as EasyEquities, and the global access without exchange control. On that first point about costs, costs really make a huge difference to the net investment return that you receive as an investor. And these numbers were prepared by National Treasury that I'm showing you on the slide. And essentially, National Treasury highlighted how important it is to have a competitively priced portfolio, especially for retirement funds that are investing over the long term. So a member in a retirement fund can expect to be invested for 30 to 40 years in a certain portfolio, and over such a long investment horizons, high fees for investment portfolios can really eat away into the returns that members will receive. And although we're not necessarily speaking about retirement funds here, if any of you are investors that plan to invest for the long term, the same thinking needs to apply. If you're investing in for the long term, over the long term, on a cumulative basis, high investment fees can really be detrimental to your overall investment return that you receive. And if you look at the bottom of the slide, really the summary on these findings from National Treasury were that if a regular saver is able to reduce the charges on the investment portfolio from 2.5% of assets to 0.5% of assets, so decrease that fee by 2%, the benefit that they would receive at retirement would be 60% greater. So this really just shows you, if you're able to reduce the costs of your own personal investment portfolio, how huge the benefit would be after a number of years. And although 2.5% to 0.5%, to be able to reduce your fees from 2.5 to 0.5 might sound like a lot. If you do some research, which I have done myself, I have gone in and had a look at many actively managed funds, especially very niche sectors, very thematic kind of sectors like healthcare or emerging markets. Anything that's a little bit more specialized is quite expensive. So you can easily see that there's a lot of portfolios out there that are charging 2.5%, 3% total expense ratios. And a good example is this ETF that we're talking about today. It comes in at a total expense ratio of 50 bips. So you can easily cut the investment fees in your portfolios by moving a lot of your investments to ETFs that are very low cost. And there's many ETF providers in SA. There's many different options that investors can choose from, but why specifically Sygnia ETFs? Well, one thing that we do quite differently to some of our competitors is we manage the direct holdings of ETFs that track global indices ourselves. So what that means is, if, for example, we are talking about the S&P 500. So the S&P 500 is a global index. It tracks the performance of the 500 biggest companies listed in US exchanges. What some of our competitors would do is they would buy into a feeder fund, meaning that they would buy into a BlackRock S&P 500 ETFs, wrap it up and sell it to South African investors as whichever company in South Africa, and it's the S&P 500 ETF. What we do quite differently is we don't go to big global passive managers like a BlackRock and have a look at their ETF offerings and take one of them, wrap it up as a Sygnia ETF and list it on the JSE. We physically manage the direct holdings, meaning that if there's 500 stocks in the index, we are physically buying those 500 stocks. We are not relying on a BlackRock to buy those 500 stocks and then for us to just take that product as is and list it in South Africa. So why is that important? Well, it cuts one layer of fees. Of course, you wouldn't be able to use the BlackRock product. I'm just saying BlackRock as an example, but you wouldn't be able, you would have to pay BlackRock for the use of that ETF. So that's one fee layer that you're able to cut. And in additionally, by managing the direct holdings ourselves, we are able to really control the costs of the portfolios. So we manage direct holdings. And we work with a very big market maker. The name of the market maker is Jane Street, and Jane Street are, huge. They have offices all over the world. They have offices in various regions that allows them to literally trade around the clock. So they're able to trade in various markets, and they trade on average $21 billion in global equities, bonds, and ETFs every single day. And by using such a huge market maker with such a successful business, the benefit to our investors is that we keep spreads quite tight, and then there's market depth. And we also believe that we have a long history of innovating. So we have a history of both innovating and in passive management. So our history in passive management dates back right to 2003, and that is when we replicated an equity index fund. So quite a number of years ago. And then if you look at this timeline, from about 2016, we started really thinking about themes that will drive the growth in various markets. So thematic investing for us is really about identifying what we believe will be a growth area in the world, and trying to create products that clients can invest into in order to be able to benefit from the growth in that sector. And a good example is launching the Fourth Industrial Revolution Fund, which has been very, very popular. We have it as a unit trust and an ETF. And this really talks to the theme of technology, how the world is changing around us in various sectors, and being able to invest in that theme. In 2020, we had a massive focus on health, and we launched the Health Innovation Fund. And on the back of that launch, that Health Innovation Fund is a unit trust. And on the back of that launch, a lot of clients came to us and said, please, could you launch something similar as an ETF? And that is how the idea of the Solactive Healthcare 150 ETF came about, which is the ETF that we will chat about today. And most importantly, passive investing just makes sense. Fees are low, as we've already mentioned. Performance is there. If you have to compare in general how active managers have done versus passive, it is very difficult to justify using an active manager that charges much higher fees. You are way better off investing into a low-cost ETF that will give you that market exposure. As I mentioned a little bit earlier, when we looked at that graphic that shows you the different types of ETFs, you as an investor are no longer limited in terms of what you can find in the ETF space. There are many, many very niche sectors available, and there's no need to go and pay, exorbitant fees to certain asset managers that can give you exposure to very niche sectors. And then with passive investing and ETFs in general, you can have very efficient and immediate implementation. If you decide today that you want healthcare in your portfolio, you can have that immediate implementation because you're able to trade ETFs throughout the day. And just on the talk of how passive investing has become so popular, and of course ETFs are part of this passive movement. If you look at the US, which is the biggest investment market, back in 2005, only about 15% of total assets managed in the US were managed on a passive basis, meaning that about 85% of total assets were actively managed. And as time has gone on, and as investors have become more comfortable with passive management, markets have also become very efficient, which makes sense from a passive management perspective. The low fees are extremely attractive to investors. And of course, the top performance that I mentioned. So as time has gone on, if we look at it today in 2021, if you look at the total assets managed in the US, now it's about a 50-50 split. So 50% of total assets are managed on a passive basis. And we can expect this trend to continue. And the last comment about active managers, if you had to still be uncomfortable with passive instruments, and you think that some of these very well-known and very experienced asset managers will be able to do a much better job at managing your money, of course that is a personal choice and a personal preference. But then the next question you have to ask yourself is, which asset manager do I then choose? And so you've made the choice to go active, and then you have to now research, do I give my money to Allen Gray? Do I give my money to 91? Do I give my money to Coronation? And what's quite evident to see from this diagram is that none of these managers can give you that consistent top performance. Active managers tend to have more concentrated, high conviction type of portfolios, they have to differentiate themselves from one another. So an Alan Gray would want to say, I'm very different to Coronation. I follow a different process. I follow a different philosophy. I have different beliefs around the investment market. And due to their processes and styles and philosophies and the way they manage money, that is the reason why none of these asset managers can outperform in every single market cycle, and the performance of one single asset manager can be quite choppy, which is another reason why we believe that at least a portion of your portfolio should be managed on a passive basis to diversify the risk away from choppy single managers' performance and to benefit from the low costs of these passive instruments. If you look at the various ETFs that we have on offer, we currently have 13 ETFs, and three of the 13 ETFs have been launched in 2021. And at Sygnia, we definitely specialize in the offshore ETFs, so ETFs that are tracking global indices. So if you have a look at the slide, you'll see that only 2 out of our 13 ETFs track local indices, and those are the Swiss 40 ETF as well as the top 40 ETF. The other 11 are all focused on giving South African investors global exposure. So if you look at the block on the left-hand side, you'll see that there's a number of regional equity funds. So these ETFs would be very suitable if you wanted to gain exposure to a certain region. So you could have the world, which is broadly speaking majority US, but it does have exposure to the European markets, to Japan, to all developed markets. If you wanted something just Eurozone specific, you could go into the Eurostoxx 50. If you wanted Japanese exposure, we have an ETF tracking the performance of the Japanese market. We have the US ETF, which is tracking the performance of US listed equities. The FTSE 100 is the UK market. The S&P 500 is US listed companies, the 500 largest. Then the S&P 1200 ESG ETF is one of the ETFs that we launched this year. So it doesn't have a very long track record, but this ETF is very good as core global exposure. It gives you exposure to both developed markets as well as emerging markets. Emerging markets is only about 5% exposure in this ETF, and then the ESG stands for environmental, social, and governance factors, meaning that every single stock that's included in this index that the ETF will track ticks the boxes in terms of ESG. And then we have the Emerging Markets 50 ETF, which is focused on the 50 largest, most liquid emerging market holdings. From an exposure perspective, it is about 50% China and about 80% Asian economies ex-Japan. Then we have some specialist funds, and these are the ETFs that really focus on a certain theme or a certain niche small area of the market. So we've got the Global Property ETF, which gives you exposure to global developed market property companies. We've got the Fourth Industrial Revolution ETF, which I already briefly mentioned, but this really is focused on future technologies driving the Fourth Industrial Revolution. And then lastly, we have the Sygnia Itrix Solactive Healthcare 150 ETF. And this is the ETF that we will unpack today. And as you can see from the name of the fund, it is healthcare focused. Just quickly from a performance perspective, we have not included the 3 new ETFs that we've launched in 2021 in this table, as they don't have a long-term track record. But if you just look at the 1-year column, you can see nice, good, positive performance across the full range, with, of course, the star performer being the Sygnia Fourth Industrial Revolution Global Equity ETF, giving us the highest return of 37.6% over the last year to 31 July. So now let's chat about healthcare. So why is the healthcare sector an attractive investment? Well, if you think about healthcare, healthcare is something that everybody needs. And if you don't need healthcare right now, it's very likely that you will need healthcare at some point in your life. And if you think about it as a sector or a certain theme, it's a case that when everybody needs something, it is a huge opportunity for investors. Then if you think about the aging populations around the globe, people are living longer and longer. In fact, some experts are saying that most of us that are in our 30s at the moment will live to 130. And the reasons why we are able to live longer and longer is due to the advancements in medicine. We are now being diagnosed a lot earlier, thanks to advancements in healthcare. We've got various medications available that can treat diseases and provide individuals with long, healthy life just by taking a certain medication and not letting diseases take over a human body. Then the cost of healthcare. We know healthcare is expensive all over the globe. And the cost of healthcare is an issue that governments cannot solve alone. So there's companies out there that are working very hard to innovate, to think about ways to make devices and medications cheaper, more efficient. And the companies that succeed in that space will benefit. Healthcare has also been traditionally described as a defensive sector. But as the healthcare theme has evolved, and a lot of these healthcare companies are not just, producing medications, for example, or vaccines, a lot of them have almost a tech focus now. They're really innovating in the space. And because of this innovation, they're now giving us as investors opportunities really through the market cycles. And I didn't want to start with this, but we do still find ourselves in a pandemic. And due to this pandemic, healthcare really is top of mind. It is something that we talk about on a daily basis. And this pandemic really has thrown a spotlight onto the industry. We now know some of these vaccine producers as household names. We're talking about the Pfizers and the Johnson & Johnsons on a daily basis. And there's a lot of interest from individuals in the science behind, some of the products of these companies. And there's a major focus on healthcare due to this pandemic. In terms of global spend on healthcare, it currently accounts for about 10.5% of global GDP. And this spend is only set to increase going forward. Now, as you can appreciate, many governments were caught off guard when it came to this pandemic. They weren't able to cope with testing, with hospitalizations, with having enough medical staff to deal with the pandemic. And experts are warning that the next pandemic might not be 100 years away. Why do I say 100 years? Well, the last major global health crisis was the Spanish flu, which was about 100 years ago. And we had 100 years on this earth where we didn't see another truly global pandemic that spread across the world until COVID-19 hit us and spread around the globe in 2020. So we can expect these diseases to happen from time to time. We can expect them to be pretty bad by spreading across the whole world and not being contained to certain regions. But unfortunately, all experts are saying that it might be a lot sooner than the next 100 years. For that reasons, governments' focus on healthcare is massive. They're set to spend more going forward in order to make sure that they are prepared the next time one of these diseases comes around. And I've already mentioned innovation, but innovation in the healthcare space is really exciting. There's so many, new technologies that these companies are thinking about. And if you think about already what is available, there's people that can put chip into their arms and wave their smartphones to check their sugar levels. So that's really a great technology for diabetes. There's 3D printed devices. There's 3D printing of human tissue. So just simply the innovation in the healthcare space is so exciting. And then, of course, this ETF will be an ETF that gives you access to the global healthcare sector, so companies outside of South Africa. And it is attractive for South African investors because healthcare is actually a very limited sector in South Africa. So if you wanted healthcare exposure in general, you would have to buy a couple of stocks off the JSE, but there's simply not enough. There's Aspen, there's a couple of hospital groups, and there just isn't enough diversification if you wanted to gain that healthcare exposure in your own personal portfolio. So just some facts about healthcare. Well, the market cap of the 5 largest global healthcare companies is bigger than the whole size of the JSE. So some of these companies that we'll chat about a little bit later are simply massive. Profit margins are big, so anywhere between 5 and 95%, depending on which company and depending on which sector and the competition in that sector. And as I mentioned, it's really the demographics that, and the changing of the aging populations that's really driving a lot of change into the healthcare sector. All of these companies that we will chat about have massive spends in terms of research and development. They spend billions each year. They have massive innovation departments, and they're really focused on making healthcare easier, more accessible, more efficient, and to keep us healthier for longer. And just a little snapshot of why healthcare is important even for growth. People being off sick has a massive knock-on effect on GDP, and in a typical year, poor health can cost the economy about 43 days, about 5% of productivity, and there's various other stats that you can read about. But being able to really improve healthcare for the general world population will result in an increase in productivity and will increase the potential for higher GDP growth. Really, it's really the innovation for me personally that's really exciting in the healthcare sector. Yes, we find ourselves in a pandemic. Yes, there's a massive spotlight on vaccine producers who, by the way, are in this fund, and we'll chat about them as well. But it's the innovations that is simply mind-blowing. And some of the top healthcare innovations that I have listed on this slide are really, really exciting, but the innovation is happening at such a fast pace that if we had to chat again in a year's time, I have no doubt that I would have another bunch of new innovations that have been listed. And some of the big ones are, as I mentioned, 3D printing. 3D printing has been used in healthcare to print various devices on a much lower cost basis, but the more futuristic thinking around 3D printing is really about human tissue, organs, transplants, which can really be life-changing in the healthcare space. Immunotherapy is a new technology, and it is used to treat cancer patients. It has less negative side effects as chemo, and it really is beneficial for cancer patients. Artificial intelligence has been, top of mind pretty much in every single industry. It's been used in finance, it's been used in all sorts of other different sectors, but artificial intelligence is being used more and more in the healthcare space as well. Now, we know that computers tend to be a lot faster than humans. They tend to be less biased than humans. They can process a lot of data very efficiently, and artificial intelligence is being used for diagnostics. So instead of my family doctor being able to tell me what he thinks is wrong with me, through the power of data, they are using, especially outside of South Africa, there's use of artificial intelligence to be able to almost double check doctors and make sure that really based on a number of symptoms and probabilities that people are being diagnosed with the correct symptoms or disease rather. Then back in the day, if you had to go to your doctor and say, I think X, Y, and Z is wrong with me, very often that doctor would refer you to, different specialists and going from place to place to perform various tests. As a lot of the technology and a lot of the devices have become cheaper through the years. As with any technology, we know what plasma screens used to cost, then it was the LED screens. Now pretty much everyone has a flat screen TV at home. But as technology gets cheaper and cheaper, it becomes more accessible over the world. And the same goes for some of the machinery or testing kits that, you know, your normal family doctor can have in his office at the moment. So nowadays we can go to our normal GP and he will be able to test for, you know, various things by, you know, a prick of the finger and little test kits. And he's got a lot of different devices that he can test you with. And as we move ahead in the healthcare space, we can expect our normal doctors to be able to test for a lot more than they're even able to test today, which already has come quite a way over the last couple of years. Then virtual reality is also really exciting. So if you put those big virtual reality goggles on, that can be used and is used already in training of medical doctors. So if I was being trained to be a surgeon, I could, you know, put the virtual reality goggles on and I could actually physically see in a lot of detail exactly where incisions are made, how to, you know, operate on a person and get that true, you know, very visual experience. But at the same time, it's also being used to inform and educate patients on the type of procedures that they may undergo. So again, if I was going to go for a certain procedure, my doctor could give me those goggles, and in this virtual reality that I'm viewing through the goggles, I would be able to see exactly what the plan is for this procedure, exactly where they might cut me, and really and truly be educated on the procedure I am about to go. And then the last one that I have included as one of the top innovations is really all of these biosensors and trackers. I mean, already our fitness watches can tell us so much. We know all about our heart rates. A lot of people have been reading their oxygen levels on their fitness devices. And, you know, pretty much anybody and everybody in a middle class kind of society has a fitness tracker. And these technologies are developing to the point where in the future it will be your watch that may tell you that you're at risk of stage 1 cancer. And we know that one of the most important things with treating any disease is to be able to identify that disease early enough. So another reasons why in the future we can expect to be able to identify things that are wrong with us very early on, quickly sort it out before it gets to the stage where it is deadly. And this is one of the main reasons why we can expect to live longer and longer. Now, how has healthcare performed? So we've spoken about why healthcare is attractive from a theme perspective, a sector perspective. We've spoken about some of the exciting innovations that are happening in the space and all of the innovations that are yet to come. But how has healthcare performed? Well, this chart only goes back to 2017. So it's quite a short track record, but this is the track record of the index that this ETF that we're speaking about today will track. And you can see that it's tracking the MSCI World Index quite nicely, outperforming over certain periods, but the general trend has been upwards and it has been behaving like normal world equities. So the MSCI World Index is an index that tracks the performance of developed market equities. And of course, let's remember that a sizable portion of the MSCI World Index is investments into healthcare, about 12%. But the MSCI World is currently still largely driven by information technology, communication services, as well as financials. So for a longer track record, I have used the MSCI World Healthcare Index. So it's a healthcare focused index, not too different from the Solactive index that our ETF will track. But you can see if you have a starting point of 2005 and you're measuring this over more than 15 years, you can clearly see how healthcare in general has been outperforming world equities. So the case has been made in terms of why healthcare is exciting as an investment. It is due to innovation, due to the fact that we find ourselves in the pandemic, due to the changing demographics. We can see that the performance is there. And this is the reason why we wanted to launch a healthcare-focused fund. So let's talk about, lastly, just about this ETF in specific. So this ETF, as I said, in the name, quite descriptive of what you can expect. So in the name, it mentions that it is a healthcare ETF. You see the number 150 in the ETF. What is that 150? Well, the index is simply made up of 150 of the largest, most liquid developed market healthcare companies. So as an investor, you can expect that the ETF will track 150 stocks. The code of the ETF is SygH, H standing for healthcare. It's a high-risk, passively managed index tracking fund, and its objective is to replicate the price and yield performance of the index. The index is the Solactive Developed Markets Healthcare 150 index. Why do we say that it's high risk? Well, any investment into equities is high risk. We know that share prices move up and down every single day and throughout the day, and you can expect that when you invest in equities that the general trend will tick upwards, but as you could see, if I flip back through these charts, you can see that the upwards tick is not smooth. You have many, many little ups and downs. That shows you the volatility of equity markets, but over the long term, you can expect that general trend to be up. What you wouldn't want, and the reason why we recommend a 5-year plus investment horizon, is you wouldn't want to invest at the top there, have a very short-term view, and disinvest in one of the dips. So for that reason, it is 100% global equity, so it is a high-risk fund. The minimum investment period, as I mentioned, for that reason, it has been set to 5 years. It's not to say that if you buy this ETF today, you can't sell it on Friday. You're welcome to, but it is recommended that you do have a long-term focus when investing in global equity. And the total expense ratio of the fund is 50 basis points. Now, why Solactive? Why healthcare? Why developed markets? Well, we chose to track the Solactive Developed Market Healthcare 150 index because we truly believe that it's really the developed economies that are driving the research and development and the innovation into the future of healthcare. So focus on developed economies was important from our perspective when choosing which index to track. And why the 150? Well, there's more than 150 global healthcare stocks, but we really want to focus on the largest of these 150 because it's really the big, massive, well-known companies that have the ability to spend billions of dollars on research and development. And it is the companies that can spend this amount of money on research and development that will be at the forefront of the innovation taking place in the healthcare sector. And the chart below just shows you the performance of this index since inception. So it goes back to 2017. And again, as I mentioned, you can see that the general trend is up, but you can see that there has been a lot of volatility along the way, which is expected when you're investing in any equity index. What you can expect in terms of exposure? Well, if you think about these 150 companies, and I will touch on one or two of them, a lot of them are US companies. So about 68.3% of the total exposure to will be to healthcare companies that are US listed. Then the next biggest exposure is to Switzerland at about 8.6%, followed by Japan at 4.6% and Great Britain at 3.7%. So largely US focused as well. And it's, I mean, not a choice. It's not a choice from our perspective. As I said, we're simply wanting the 150 biggest stocks. So it's an element of where these stocks are at the moment. The composition of the fund will always be determined by the index provider. So the Sygnia ETF will simply track what is in the index. So as at the end of July, let's have a look at what the top 10 holdings were. So as you look down this list, I have no doubt that a lot of these companies are very familiar to you. These really are the largest players in the healthcare space. Johnson & Johnson, very topical. A lot of people in our own country are receiving Johnson & Johnson vaccines as we speak. Roche is very popular healthcare company. Pfizer, another one that if you didn't know them before, I can bet you definitely know them now. Again, thanks to the Pfizer vaccine that we have been using for South Africans, and many, many other well-known companies. So these are just the top 10 holdings, and you can see their index weight at the moment, where it is at the end of July in the last column. So if we just look at some of the constituents, I mean, Pfizer, as I mentioned, definitely a household name. It is not just a US company, but it's a company that has manufacturing sites all over the world. It's got massive commercial reach. They're selling Pfizer products in over 125 different countries. Last year, they returned $8.4 billion to shareholders through cash dividends. They anticipate a very strong dividend in 2021. So really attractive company to be invested in over the next couple of years. They have huge revenue and they continue to innovate. They continue to think about new products. So if you look at this little timeline at the bottom, there's over 100 products that are in various stages. Some are at phase 1, some at phase 2. They have to go through various regulatory approvals, testing, and then finally at registration. And just what to expect from this year. Well, if you see their revenue from 2016 to 2020, you can see it's comfortably been ticking up. You might say, well, some of these numbers are not that big, but they actually are in billions. So even going from 38.8 billion in 2017 to 40.8 billion in 2018, if you appreciate that $1 billion is a lot of money, they have trended upwards. But what we can expect for 2021 is huge, thanks to the spotlight on their vaccine that has been approved in many, many regions and nations around the globe. So we can expect their revenue to jump from almost 42 billion in 2020 to closer to 80 billion rand in 2021. So again, proving how attractive some of these companies can be from an investment perspective. Johnson & Johnson, also very well known for their development of the COVID-19 vaccine, and they invest billions of dollars into research and development. So they haven't disclosed the 2020 figure, which I have no doubt is huge because they were also working on a COVID-19 vaccine. But in 2019, they invested $11 billion into research and development. And another success story for Johnson & Johnson, in addition to the COVID-19 vaccine, is that they have created an injection that can be given to HIV positive patients. And this injection can really make the life of a HIV positive person a lot more comfortable without the need to take that cocktail of medication that HIV positive people take. So this is a breakthrough that they've had this year in 2021. And the opportunity for this is absolutely huge, as there are roughly 38 million people in the world suffering with HIV, and unfortunately new ones getting infected on a yearly basis as well. So these companies really are at the forefront of thinking about solutions in the healthcare space. And another popular company is GSK, that should be very well known to you, especially if you look at that little orange logo at the bottom. And if you look at their business, also very well diversified. So what I'm really trying to show you here is that, yes, you're investing in healthcare as a theme. This whole ETF is healthcare focused. But it's diversified in the sense that, firstly, you're not putting all your money into one single company. Yes, you will buy one ETF, but the ETF itself is exposed to 150 different companies. And even within these 150 companies, a lot of them have different geographical exposures. And in addition to that, their businesses are often very well diversified. So GSK's business can be split into three major focus areas. One is the pharmaceutical, one is the vaccines, and then of course consumer healthcare. And in fact, seeing as vaccines are so topical at the moment, GSK is the world's largest vaccine company if you have to measure that by revenue. Then in the pharmaceutical space, they have, various products that focus on respiratory illnesses, on oncology, etc. And in the consumer healthcare space, they have products that we can buy off the shelf. And interestingly enough, this last little picture that I have here, this little blue vials, this is something that they created called Novamin. And it's the key technology that's used in the Sensodyne repair and protect toothpaste that many of us may use. And then the last company that I really want to touch on is this Teladoc Health. Now, I've mentioned innovation a number of times today through my presentation, but if you have to Google top 10 most innovative companies, many different lists will come up, and there's even lists within subsectors of healthcare, but on pretty much every list of innovative company, Teladoc Health comes up. And Teladoc Health, to put it simply, it really is about digitally connecting patients with healthcare practitioners through apps. So if you look at this bottom, the middle bit is just a representation of what the apps looks like. And it's about having, a virtual platform where you can connect with your doctor, which has been extremely helpful, especially through the COVID-19 pandemic, where people have been afraid to leave their house and not wanting to go to hospitals. But there's also a major focus on mental health. And we know that mental health is a huge issue all around the globe, and even more so in 2020, when people have gone through, or since 2020 rather, still going through, dealing with loss due to this pandemic, dealing with isolation, again, due to this pandemic. So mental health is huge. And because this Teladoc company is essentially a very tech-focused, data-heavy kind of company, they also collect a lot of data, and they're able to analyze the data and actually see what certain trends are. And on mental health specifically, if you look on the right-hand side at the bottom, they have tried to measure the impact on virtual care. And 76% of patients had improved, their depression had improved after 3 visits, and these are virtual online visits. 75% of them reported that their anxiety had improved after 4 visits. And then overall, there's about a 55% reduction in people's depression scores. So really positive changes that they're able to make through this, meeting of practitioners and patients on a virtual platform. And then on the left-hand side, some of the stats that you'll see is just the impact of virtual care in general, which covers mental health as well as just normal primary care and complex care. So this company is not just about data, just about the tech and about connecting people. They also produce various devices that can make life easier for virtual consultations. So very much on the tech side, and very much, forward thinking in terms of where the healthcare sector is going forward. And then one more company is Intuitive Medical, and again, it's just around devices, and they have 2 very popular devices. And if you look at this little graphic over here, you will see that they have this Da Vinci device that is one of their most popular devices, and what this device looked like back in 1996 and what it looks like today. And this Da Vinci device is really used to make very small incisions into people's bodies without being too intrusive, and the accuracy in which this can be done, is the surgeon would essentially put the goggles on of this last little picture and be able to get a really close-up view of exactly where in the human body he can make this incision. And then something else that they're very well known for is they have this ion endoluminal system, which also enables biopsy of very small, hard to reach nodules, and it's also very much tech focused. So all of these companies that I have covered just as quick little highlights of what you can expect in the fund, they are all included in one of these 150 companies that you can expect to track in this index. So the ETF will be available, or it's already available, 6th of August listed on the JSE, and 17th of August it will be listed on the secondary exchange, which is A2X. And then just to end off with a couple of quotes on ETFs in general, as Jack Bogle says, it's not about looking for the needle in the haystack, but with ETFs, you can buy the whole haystack. So if you think about even this product that we're talking about today, instead of trying to think, is Pfizer the one to buy? Is this Intuitive Surgical or Teladoc Health the one to buy? Why not just buy the whole ETF, have exposure to all 150 of them, instead of trying to think today, which will be the company that gives you the most return over the next couple of years? Then another one from Dave at ETF.com. He says, ETFs are fundamentally a technology. There are mechanisms to achieve a certain goal, like phones. Traditional mutual funds or unit trusts were the rotary phones, and ETFs are the smartphones. They do the same thing, but they are in a better package. Why they're in a better package? Because you can buy and sell them on an exchange. Then John Stein believes that ETFs will be the investable default for investors in years to come. It's because they are lower cost, they're transparent, they offer great liquidity. And Martin from BlackRock says, ETFs aren't just having a moment, they are creating a movement. So we truly do believe that ETFs are the future. So thank you very much for listening to me today. We have a few minutes to answer some questions.
Awesome. Thanks so much, Eva. That was really lacquer and very comprehensive. So I've been really looking forward to this ETF and learning more about it. So I really appreciate the whole presentation. I'm sure our users do too. I see that there's 1 or 2 questions there. If anyone else has questions, please pop them in there. Like you said, we have 1 or 2 minutes. Eva, I don't know if you want to look at those as well, maybe putting in some more there.
Yes, so the first question I have on my side is, will this ETF pay quarterly dividends? So this ETF will pay dividends, but we pay dividends semi-annually. So Sygnia's ETF dividends are paid in June and December of each year. So as the companies, these 150 companies pay dividends, we will then distribute those to our investors. Then the next question says, if the management company issuing the ETF goes bankrupt, how safe is our money? Well, we don't even want to think about that, but your money is safe. There's many, many regulations out there that are there to protect investors against, such events, essentially. So when we launch an ETF, we go through various regulatory bodies, and there's a lot of legislation out there that is there to protect investors. I don't see any.
A moment or two to see if they have any more.
There's one more. Does this ETF in any way duplicate the holdings in the Fourth Industrial Revolution Fund? So the easy answer is no. There may be at times where you have an overlap where one company may appear in both. So, but the Fourth Industrial Revolution Fund is the weighting methodology of the Fourth Industrial Revolution Fund is a non-traditional weighting methodology. A lot of indices, including the Solactive Developed Market Healthcare 150 Index, are what we call market cap weighted, meaning that the focus is always on the largest, most liquid companies. So it's dependent on market size. So as a company becomes larger and larger in the market cap, they'll become bigger and bigger as a percentage of the index. The Fourth Industrial Revolution Fund, with that non-traditional weighting methodology, the way the weighting methodology is done is, there's a lot of AI and things in the background that dictate which holdings should be there. But essentially, in a simple way to think about it is the companies that would have the largest weight would be the companies that will have the largest impact on the Fourth Industrial Revolution. So you may find that very small companies, they're still listed and they meet certain liquidity requirements, but you may find a lot of small companies, due to the technologies that they are busy developing and launching, if they are set to have a bigger impact on the Fourth Industrial Revolution, they will have a higher weight in the methodology. And for example, Tesla is one of the top 10 holdings of the Fourth Industrial Revolution Fund. And if it was market cap based, Tesla would be a huge percentage of the index, whereas it is actually a lot lower than some other companies. So due to that, the overlap should be minimal. The Fourth Industrial Revolution Fund does have exposure to a lot of less well-known companies, but they're making a true impact on the future. And also not just healthcare focused. There's space exploration and all sorts of other technologies in the Fourth Industrial Revolution Fund, whereas this one is very much healthcare focused. Although there's tech innovation within the healthcare space, it's still focused on healthcare.
If that brings me to a question I wanted to ask, if there weren't many more coming in, is what would be your next ETF that you're looking to list, and would it be this year as well?
It's unlikely to be this year. So we have already applied to the FSCA to list another product. It will be a regional focused type of ETF that's very much focused in one of the emerging markets and a certain subsector of that emerging markets, which is kind of the new economy. And there's another one in the pipeline as well that's very tech focused, but it's also likely to be only in 2021. So it will be tech focused, but also quite a niche sector of tech.
Awesome. I really like that. See, there's not many more questions, and it has been an hour, so I think we'll call it there. But really, thank you very much, Eva, and thank you to everyone for joining us today. Like I said, I'm really excited about this ETF, and I really want to see how well it does, because I think it can resonate well with the market, with everything going on.
Thank you.
So thanks, everyone. Have a wonderful day further. Cheers.
So easy, so easy, so easy, so easy.